Welcome to the Trading Market Technicals morning call video for Tuesday, December 11th. Another choppy, slow day yesterday, another consolidation day. Again, as I mentioned in previous videos, is acting as a bullish setup, and I'll show that to you in the charts. Just want to run through the numbers. Gold up 7. Want to show you a gold chart of what we talked about yesterday. Nasdaq up 9. Dollars down small, about 22 cents. S&P up fractional, and the Dow up 14. Again, as you can see, strength in the Dow Jones was pretty much very visible during the day. But the markets continued to consolidate for probably the last couple of weeks, and we thought the non-farm payrolls would do it, did not. We're sitting here just kind of grinding slowly higher, drifting in no man's land, and this has been going on for the last couple of weeks. Now, when that happens, you don't want to be short in a dull market. We don't want to be short up here, and any longs usually doesn't follow through. So we have not been getting any follow through. And it's very frustrating to sit there in front of the screens all day waiting to see. But nonetheless, that's our job, and we have to focus on risk. We also have to focus on what is opportunity that's going to be presented to us during the course of the day. So I think my guess is going to be the FOMC rate decision. Today we have very little trade balance, 8:30. Wholesale inventories could get a little reaction, but nonetheless, it's going to be the FOMC rate decision. Now, that rate decision is probably going to either sell, put a big sell signal in gold, or gold is going to rally if, of course, the Bernanke speaks of a further accommodation, of a further easing. Then I think gold is going to get that lift that we're looking for. Now, gold is looking really ripe for a rally, but again, we don't want to do anything now that we're so close to FOMC. I'll get into a gold chart in a moment. But I want to show you, I mentioned yesterday about how we're getting some mixed signals, not just indicators. Indicators are telling us everything's okay. We are consolidating, right? We did get a very small little pullback, and now we've been consolidating. The thing to me that what bothers me, and I don't think that's going to be in effect going into the next 3 weeks of the end of the year, we usually get that seasonal strength coming into that Santa Claus rally. Now, we haven't really seen it yet. But since we're consolidating, it's a very good sign that we're going to, we should rally, at least test the highs. Now, the 1424 in the S&P is a big area. 1424, 1430, I'll show that to you in the S&P cash chart on a daily, looking at a daily perspective. But, we could sell off one more time, which hopefully that'll happen so we can buy into the market. Now, since we've consolidated, if anybody looking to play the market long, if we get that breakout the first day on a closing basis, we need to follow through on the second day. So I wouldn't really just looking to buy stocks on the first day if you're swing trading it. So take a step back. Let's see where the market closes if we do break above there. Now, what I am seeing is small caps are starting to perk up. When that happens, usually it's the end of the cycle. It's the last push up. So to me, it looks like going further out here into January, if we do push up and the small caps do rally pretty hard, which would be the IWMs, which we'll look at, and we'll do our analysis, then I think that the markets are going to be due for a pullback come sometime in January if we do not get one in the next week or so. So that's going to be my analysis. And also we mentioned that stocks that should not be rallying are rallying, right? The XLU utilities, healthcare, and consumer staples. I want to just show you a chart of that, just to show that also doesn't mean that the market is going to pull back, but it just gives me warning signs when I dig down deep into the market, basically checking under the hood. All right, so we know that the FOMC statement on the December 12th is going to be big, which will be tomorrow, and that's coming out at 12:30, and that's something that we're going to really, really carefully watch, and I would not be long or short going into that FOMC rate decision because the market does get pulled back and forth in all different directions. Take a look at quickly the 10-minute chart. Again, guys, really nothing has changed technically in the S&P, in the indexes. As you can see here, we did break above it, this channel that we've been in for the last 2 weeks, and we closed above it. Again, a good sign. Futures were down after hours, and now they're up 3, so very resilient market, and that's why I say stay away from the shorts as far as swing trading. Intraday, total other story, but stay away from the shorts. Shorts and longs really haven't been working. No follow-through in the last couple of weeks anyway. Okay, so now let's go into our analysis. We have here our fib. I reversed the fib from here, from the low end to the top end here, and what we are is we're sitting on that 61.8% retracement, and that's where I'm looking at my target, my heavy resistance area, this horizontal red trend line. So 1424, 1430 is going to be decent resistance, but if we break here, this dark blue line, That's our trend line, and not necessarily a head and shoulders on the S&P cash, inverted head and shoulders, excuse me. We do have a left shoulder here. We have our head, but our right shoulder needs a little bit more, a little bit more to take shape, if you will, right to that 1405 area. I'd like to see a little chopping around more, maybe a sell lower here for the next couple of days, and then look to break out. So really not the best. So I'm not going to really call it a head and shoulders, but we do have a rising wedge into this resistance, which we've been in for the last 4 days. So let's take a look and we'll watch what happens with that. But again, nonetheless, that bearish rising wedge is not bearish unless it breaks and closes on a closing basis. Take a look at our CCI index that I mentioned to you, that I showed you the last week. Big breakout above, and usually stays above that 100 area, and as you can see here. So that means that this rally was really a true rally, really good rally here. Okay, but what happened is, as CCI starts to fade, look at what happened on the next rally up. We haven't even gotten up to this point, and as you can see here, as we rallied up, we were up above over 100. We just barely got over 100, now 125, and now we're just sitting down here. So this is telling me that if anything, the rally has weakened, momentum has weakened, and that does not mean that it can't push higher, but I'm just saying that this rally will probably, when it ends, will be sold into in a big way. Okay, and that could be in January. We don't know that, but I just take a look at this momentum here is waning to the upside. All right, so let's take a look at this S&P 60-minute chart. And I've changed things around. As you know, I showed you some positive divergence here. I left these up. I just cleaned the chart up a little bit. And as you can see here, we have this inverted head and shoulders on the bigger time frame, 60-minute bigger time frame, which measures up to 1513. So it's real simple, right? Take the head, bring it right back down here. You take it to the neckline, and then you just take that, just to make it real life, everybody's life simple. 1513 would be a projected target. Does not have to get there, but I'm seeing a lot more bullish setups now than I am. And that actually could fake us out as well. But we need to know that there are more bullish setups. I scanned stocks last night. I've seen a ton of positive uptrending stocks that are looking to break out. And if the market does break out, then that's why these stocks will break out as well. Okay, so that's something that I also want to take a look at. But this is, again, now this bearish rising wedge we broke out of has not broken down. So we've been stuck here above this area. To me, this is going to be a failed bearish rising wedge. But we'll leave it there for now just to show you, just to see for purposes. S&P 30-minute chart, we could see that we've been trending literally into the consolidation mode, and now we're sitting here pinching. This tells me, again, guys, it doesn't tell you direction, but watch out for a big move, and probably it's going to be the FOMC tomorrow, and what direction this market's going to move in. Spiders, same thing. A little bit more of a right shoulder here, as you can see, but again, this slanted neckline is going to tell us really if we're going to break out, and we're going to test at least these highs up in this area here. So this is something that we're going to be watching, and as you can see here, as we get higher, we're going to have that lower trend line resistance up above. And again, 30-minute chart here, which is a smaller head and shoulders I've been showing you. That's a 145 target, 145.25 in the 30-minute chart of the spiders. So we'll just keep an eye on these, but we need to know that we're getting a little bit more bullish setups. Another one, transports, had a nice day yesterday. Again, really big for the bullish camp. If we break out of this on a closing basis, I think all bets are off to the downside, and we will get that Santa Claus rally. Transports acted really well. A lot of the truckers are doing well. I don't trade the transports, but very boring sector. But it's definitely something that needs to be in your toolbox that you should be watching on a regular basis. Diamonds, as you know, we had the big diamonds, which is the Dow Jones ETF, moving much better than our other sectors, which gauges better risk. But this is not what we want. But again, a rising wedge up here, and it's only bearish when we break below on a closing basis. But again, good setup. We are above the 50-day moving average. So again, another good spot here on the bull camp. Let's take a look at these IWMs. Now, IWMs, big move up, big two gap areas, which I think that we did get a gap area fill here that one day, right to the penny. And I'm seeing this now as more of a inverted head and shoulders here on the IWM ETF. Now, and it kind of sets up nicely, because as we know, the end of the move, we get more volatility and more of these lower cap, crappy stocks $1, $2, $3, $4 tend to move, and that's going to be probably setting up for some good trading in the next couple of weeks as well. So you might see a lot of these smaller cap stocks, the micro caps at $2 to $1 to $10 move higher, and that's going to tell you that the end of this rally is going to be near. So we need to look at this, but watch this on a break higher and above this lower trend line as well. Then I think we're going to get a real run for the test of the highs. Now the Russell, look, I was looking more for a pullback, and we did not get it. So that's going to tell you that strength in the Russell is meaning that there's going to be risk on in the market. So let's just keep an eye on this though. Watch this today, 82.88, 82.90 on a break higher. That would get us to engage a little bit more risk on. XLF again holding nicely right above this area. So we're just inside day from yesterday. But, use the 15-minute rule, guys. That'll definitely keep you out of trouble. First 15 minutes, up and bottom, run a parallel line across it and see where we are. If we're above it, we have new order flow to the upside. Below it, we have new order flow to the downside. And we should be looking for some short trades and or buy-side trades, upside targets. And that'll give you some area. If within the 15 minutes we have an inside day, there's really no new order flow. You got to be really selective in your trading. All right, let's take a look at Apple. Apple at one point was down like another $7, $8 in the early on when the market had opened. Actually recovered, and we have this little indecision candle here. This stock looks so bad, and I'm not looking to trade it. I wouldn't be long it here. I wouldn't be short it here. I think that if anything, for a real good trade, that 467 area is where I would be looking to buy Apple. I'd be buying a good bunch of options here. And that would be only for a trade. I don't trade it, but you need to do analysis on it because it's a big factor in market. If Apple can't even rally from this big engulfing candle, at least 50%. So today, let's see if this Apple can get momentum here to the upside as we get closer to Christmas. Maybe this will catch a little bit of a bid here. But again, look at these indicators. They look terrible. Stochastics rolling over, RSI rolling back down again. MACD is like basically a watershed sell-off here, looking worse than it is. So it's just not looking pretty, and that's something that I mentioned to a lot of traders that have emailed me. I wouldn't be looking. If you're long, I'd be protecting your stops. Your stop's going to need to be below the low here, 488 at a bare minimum. If you're short, there's going to be risk to the upside, obviously. So, and again, they could announce a special dividend, which that would put all bets off to the market to the downside, and we would really rip higher into the year end. But again, who knows? That's only a what if. And as you can see here, I mentioned this gap area needs to hold. We closed just at the low of this gap support area. A breach of this on a closing base is going to send this stock at least to the 505 area, if not lower to that lower trend line. Okay. Lastly is the Qs. We're sandwiched between the 50 to 200 and above the 20. So we're sitting right here. And again, it's no help with Apple as well. So keep an eye on the Apple. Really good analysis to get an idea of where this market's headed. Again, guys, we're coming into seasonal strength. We haven't seen it yet. My guess is going to be this non-farm payroll. Excuse me, not non-farm payroll. The FOMC statement, and that's going to put pressure on. It's going to give us a trade in gold. And let me show you gold right now. Gold. We rallied up nicely, but we have this confluence area of resistance, which is the 50 and the 20-day. We are below it. Again, I'd like to see this one dip lower, and maybe the statement will indicate that in gold, and we'll move lower, and then we get a nice little buy-in here going into the end of the year and into January. And I mentioned GDX, and I showed you GDX here. Just open this up a little bit, and I mentioned it's a nice little trade setup here, and it happens once we get a break on the outside and we get closed back in, we usually get another test lower, and that'll be that double bottom area here. If you see that, you notice that right here and here. So let's see if this projects. We do have low volume. As you can see here, we have low volume on this pullback in GDX. So that's something that we want to take a look at. And lastly, I want to show you a couple of things. Dollar. We're sitting on at the area of resistance here, this horizontal trend line. We do have confluence of resistance above 200, the 20, and we're above the 50. But we have a lot of work to do to really initiate this to move higher. This our ratio, dollar S&P, as you can see, has flatlined. So we'll see what the dollar, what kind of reaction it gets, and probably more than ever is going to be looking for the FOMC statement. Really, what comes down to it. Now, a couple of things that I mentioned. What I don't like is the utility stocks have rallied, as you can see. Now that's also, we did have a big sell-off basically with this end of year taxes, because everybody wants to take their profits before the new tax laws come into effect. But again, I see the XLU rallying really hard while the market's holding in there. And then let me show you the ratio chart here of the XLP, which is the consumer staples versus consumer discretionary. We do not want to see this starting to move up, right? We want to see the opposite. We want to see this selling off, as you see, as it did here, where the market's rallied. Okay, so this is not a good sign. Not that it's anything bad right now, but we don't want it really taking out the 77.5. If we start taking that out, then money's obviously flowing out of risk-on assets and going into, could be even the Dow, like it has been, and some of these consumer staples, healthcare, which I want to show you. Well, this is the healthcare and the consumer staples and consumer discretionary, and then also the XLU, which would be utility. So again, something to keep an eye on that really is giving me a little bit of a red flag, but we'll see. Put call ratio, guys, actually still holding a little bullish here, but we really don't want to see this starting to spike up either. So this is right now contained, so this is also a bullish sign. All right, guys, have a great day, and we'll talk to you tomorrow.